There are some similarities, but there are market differences, Scott. And one of them is just the valuations we're trading at right now. Back then, S&P 500 technology companies, the large cap ones, traded at around 67 times earnings. Today, it's more like 17, 18. So valuations are already a little bit more reasonable if you want to look at them on a relative basis. But here are some of the companies, right? Intel, it was big then, it's still big now. But back then, in March of 2000, it was a $400 billion company. That's not even adjusting for inflation here. It traded at 57 times earnings, so a lot of growth expectations built in. Today, it trades with a value of $164 billion, but trades at a much more reasonable, on a relative basis, 15 times earnings. Oracle, a software giant, also around back then, it was a $230 billion company. It traded at 167 times earnings, so a lot of growth priced in there. Today, it's a $192 billion company. It trades at 18 times earnings. It's not just about the stocks overall, though. Take a look at some other metrics that we were looking at here. Look at the tech leaders that we've seen just over the past couple of years. These companies didn't exist back in 2000, but now they are really helping to propel what's the NASDAQ composite and the 100. Netflix up 149% over 2 years. Facebook 168%. And then Tesla up 450%. That's a 2-year return. But remember, these companies weren't around. They're leading things now, but we shouldn't forget about the companies that are no longer with us, really, at least substantially in their current form, if even at all. Look at names like Netflix, the old web browsing company, Broadcast.com, Lycos, Pets.com. Some of these were acquired, some of these went away, but they're no longer with us. So it just reminds us that there are casualties in this, not just the ones that survive, guys. Back over to you, Scott.
All right, Dom, thanks so much. Mike Santoli, you say there definitely are differences. It is not at all like it was then.
Not at all. I mean, in fact, it's hard to find things that are very similar. It's a completely different index. It's not composed really the same way. And honestly, the tech stocks, the stocks at the top of the NASDAQ right now are really just other stocks. It's really less of a distinction between this one distorted piece of the market in 2000 that was driving things. By the way, the NASDAQ spent almost no time above 4,000. Let alone 5,000. It basically was one shot. It was a needle to the sky, and then it was immediately over. So almost nobody owns it at these levels. It's kind of very little muscle memory in the market, I think, connected to NASDAQ 5000.
Hey, YouTube fans. I'm Landon Dowdy from CNBC. Thank you so much for checking out our channel. You can subscribe by clicking right here to check out the latest Mad Money CEO interviews, market news, financial advice, and product unboxing. Enjoy.